The Federal Reserve just raised rates, but it is ultimately going down in reality. Let's talk about it. What is happening in the real estate market? I'm struggling to make sense of the fluctuating property values, which seems to vary greatly depending on the region you live in. The West Coast is experiencing significant drops, while the East Coast is seeing substantial increases. It's clear that location matters. However, I can offer some insights into the changes in mortgage rates and the reasons behind them. Let's explore what the Federal Reserve stated recently and its impact on the market. After making their decision on interest rates, Federal Chairman Powell presented a statement with only minor changes in wording. Some interesting questions were raised, such as whether the Federal Reserve is planning to hold rates for a long time or cut them next year. The chairman emphasized data dependency and mentioned that monetary policy will likely need to be more restrictive for a while to combat inflation. While the Federal Reserve rates its interest, it's important to note that mortgage rates are determined by bond yields, which are influenced by various factors, including market demand and future economic expectations. Despite the rate hike, mortgage rates may actually decrease due to its investors' interest in mortgage-backed securities, which affects bond prices and lowers yields. Looking ahead, the Federal Reserve's dot plot, indicating where they expect rates to be in 2024, suggests a potential reduction in rates by around 1.25%. This could have implications for various markets, including real estate, as interest rates continue to play a crucial role in housing trends. Furthermore, it appears that interest rates have peaked and we might see some moderation in real estate market. However, it's important to remember that the housing market's performance remains regionalized, so the local context matters greatly in understanding the real estate dynamics in specific areas. As mentioned earlier, real estate trends are highly localized, and regional factors play a significant role in determining property values. Economic growth, job opportunities, population shifts, and supply and demand dynamics all contribute to variations in real estate values across different areas. For example, in metropolitan cities with strong job markets and limited housing supply, property values may continue to rise despite changes in interest rates. For inflation concerns, the Federal Reserve's recent actions, including raising interest rates, are driven by concerns over inflation. As inflation increases, the purchasing power of dollar decreases, leading to higher living costs and economic instability. The Federal Reserve's effort to combat inflation through monetary policy can have a ripple effect on mortgage rates and borrowing costs. Market sentiment and investor behavior also influence real estate trends. When investors expect interest rates to rise, they may rush to secure mortgage at current lower rates, driving up demand for properties. On the other hand, rising interest rates could deter potential buyers, leading to a slowdown in the market. In government policies, various government policies such as tax incentives and home ownership, subsidies, and regulations can impact the real estate market. For instance, tax breaks for homeowners may encourage more people to buy properties, boosting demand and potentially increasing property values. Changing demographics such as the aging population or shifts in generational preferences can influence housing demand and the types of properties sought after. For example, younger generations might prioritize urban living and affordable housing options, while older generations might look for more spacious homes and retirement communities. The real estate market is also affected by the global economic trends and geopolitical events. Economic conditions in other countries, international trade relations, and global investment patterns can impact the overall stability and attractiveness of the U.S. real estate market to foreign investors. The supply of available housing units in the market plays a crucial role in shaping property values. Limited housing inventory can create a seller's market where demand outstrips supply and drives up prices. Conversely, an oversupply of homes can lead to a buyer's market where sellers may have to lower prices to attract buyers. Technological innovations such as virtual tools, online property listing, and real estate data analytics have transformed the way buyers and sellers interact with the market. These advancements can streamline the buying and selling process, making real estate more accessible and efficient for all parties involved. Overall, real estate market is a complex ecosystem influenced by numerous interconnected factors. While the Federal Reserve's interest rate, decisions, and policies have a substantial impact, it's essential to consider the broader economic, demographic, and market-specific influences to fully understand the ongoing dynamics in the real estate sector. Let us know your thoughts in the comment section below. Thanks for watching. See you in our next video.